Credit Suisse, one of the world's largest banks, has recently been in the news for all the wrong reasons, as you may have heard. The bank is in the middle of a huge financial crisis that is sending shockwaves through the world's financial system. What precisely happened then? In fact, Credit Suisse had a sizable stake in the recently defunct hedge fund Archegos Capital. Because of this, Credit Suisse has lost a lot of money, and the value of its stock has dropped sharply. You may be wondering why this matters to the global economy. In this video, we'll find out. Also, if you haven't already, please subscribe to my channel. If you want the most recent information, press the bell. Let's get started. Credit Suisse, which has been around for over 160 years and originally catered to the ultra-wealthy elite, is facing some serious turbulence. The bank is also known as one of the global systemically important banks, along with only 30 other institutions such as JP Morgan Chase, the Bank of America, and the Bank of China. This historic yet struggling bank has sent shockwaves through global markets, and people are worried about the impact it could have on rising interest rates and the stability of the financial system. To make matters worse, Silicon Valley Bank also collapsed just a week ago, creating even more panic and uncertainty. These two major banking crises, which happened within just 2 days of each other and on 2 different continents, are causing some people to wonder if we're headed for another global financial crisis like the one we saw in 2008. If any of you don't know, at first, there was only a small drop in economic activity, but it got worse in the fall of 2008 when the stress on the financial markets was at its highest. The outcome was the worst recession since World War II, with the United States gross domestic product, GDP, declining by 4.3% from its peak to its trough. And now, Credit Suisse recently announced that it had discovered some issues with its financial reporting, which it called a material weakness. This statement shocked the markets around the world, and investors became nervous and tried to limit their risk. Credit Suisse lost $7.9 billion, its biggest annual net loss since the global financial crisis, and customers withdrew $133 billion from the bank, mostly in the fourth quarter. As a result, the bank's shares took a nosedive, dropping as much as 30% and even triggering a trading halt. That's a pretty big deal, but things aren't all doom and gloom. Based on a report in the Washington Post, the Swiss National Bank issued a statement saying that it would provide liquidity to Credit Suisse if necessary. And sure enough, they came through with a $54 billion lifeline, which helped calm European investors and led to a rally in the markets. Analysts at JP Morgan say that the Swiss Central Bank's help of liquidity may not be enough because the market's confidence is still low because of Credit Suisse's plan to split off its investment bank and lose money in other parts of its business. Even though the liquidity support could buy Credit Suisse time to rebuild trust and move forward with plans to restructure, such as creating an independent business in the US and focusing on managing money for wealthy clients, the bank may still face problems in the future. The reason Credit Suisse's troubles are so significant is that it's such a huge bank that its failure could have wider implications and even trigger a global financial crisis. Some analysts said that the focus might now move away from Credit Suisse and toward other parts of the banking sector. The stock market went down a lot because of the effects of the financial crisis in Switzerland and Europe. Specifically, London's FTSE 100 index witnessed a sharp decline of almost 4%. Notably, the adverse effects also affected the US market, where the shares of major banks such as JP Morgan Chase and Citigroup recently plummeted by more than 5% and 6.7%, respectively, although US stocks showed signs of recovery afterward. There has been conjecture suggesting that the current Credit Suisse crisis is intricately linked to the recent implosion of 2 regional banks in the United States, namely the Silicon Valley Bank, SVB, situated in California, and the Signature Bank, located in New York. What's your opinion on that? It also affects interest rates in the euro area. They shot up from minus 0.5% last June, all the way to 2.5% in February. And get this, just a few days ago, the European Central Bank announced yet another half percentage point hike, taking rates all the way up to 3%. Apparently, they're more worried about stubbornly high inflation than recent banking turmoil. The Saudi National Bank bought almost 10% of Credit Suisse last year and has decided not to buy any more shares in the Swiss bank. This is because Credit Suisse reported weaknesses in its annual report, which showed that it wasn't doing a good job of assessing risk. This refusal by the Saudi bank to invest further came at the exact time when Credit Suisse's troubles turned into a full-blown crisis. Ammar al-Qudairy, the head of the Saudi National Bank, said that if the Saudi bank owned more than 10% of a company, stricter rules would be put in place. Currently, their stake is at 9.8%. Interestingly, Qatar's sovereign wealth fund is another large investor in Credit Suisse, with a 6.8% stake, according to a Washington Post report. Did you know that in 2013, Qatar converted more than $4.5 billion of Credit Suisse's debt into bonds called additional Tier 1 capital notes? Well, it turns out that these bonds are going to be wiped out as part of Credit Suisse's deal with UBS. However, it's unclear whether Qatar still owns any of those bonds. Here comes another interesting fact. Credit Suisse is the 12th largest foreign bank in India, with assets worth 20,000 Indian rupee crore, and has a presence in the derivatives market, as per a report. The report highlights that the bank funded 60% of its assets from borrowings, with 96% of it happening in just 2 months. However, the bank's assets in India are relatively small, with a share of just 0.1%. Analysts are watching out for any liquidity issues and their potential impact on the counterparty risk assessment in derivatives, given how important Credit Suisse is to India's banking sector. Analysts think that the assessment of counterparty risks, especially in the derivatives market, may need to be changed less. Some experts believe that an SVB or Credit Suisse-like situation is unlikely in India, given its stringent liquidity norms for the banking system. Even though the Credit Suisse or U.S. bank crisis might not directly affect the Indian banking system, experts say it might affect the Indian industry. The Reserve Bank of India will keep a close watch on the liquidity issues. Guess what? India has put in place some measures to protect itself from bank crises, like what happened to SVB and Credit Suisse. The country has implemented Basel, the third norms for its banking system, which require banks to maintain a liquidity coverage ratio. Surprisingly, this ratio wasn't there for SVB and was only partly there for Credit Suisse. So what does this mean? Well, it's basically a limit on how much banks can invest in a held-to-maturity, or HTM, portfolio. Sounds like a smart move, doesn't it? Listen to this. Credit Suisse has also been embroiled in a number of scandals in recent years. Forbes says that in June 2022, the bank was found guilty of not stopping a Bulgarian cocaine trafficking ring from laundering money, which is hilarious. As punishment, the Swiss government fined the bank and ordered it to pay a whopping $20 million. And that's not all. In a different case last year, a Bermuda court determined that the former bank run by Georgian Prime Minister Bidzina Ivanishvili and his family was due $500 million in damages from Credit Suisse's nearby life insurance company. Not to mention the scandal that forced Credit Suisse CEO Tidjane Thiam to resign in 2020 after it was revealed that the bank had hired private investigators to spy on its former head of wealth management after he left to work for a rival bank. Oh, the drama. What's your thought on that? Share your thoughts with us in the comments section below. The truth is, the Credit Suisse scare may be just the tip of the iceberg. Andrew Cunningham, the chief European economist at Capital Economics, just warned that the current Credit Suisse crisis is a much bigger problem for the world economy than the failure of 2 regional banks in the U.S. He's calling on regulators to act quickly and decisively to avoid setting off a chain reaction that could destabilize the markets even further. But that's not all. NYU professor and economist Nouriel Roubini is calling on the European Central Bank and the Saudi National Bank to give Credit Suisse some liquidity. Roubini cautions that the European Central Bank should not repeat the mistake it made during the Eurozone crisis in 2011, when it raised interest rates by 50 basis points. The experts' predictions of a global pandemic and the government's frantic attempts to find a solution make it clear that this story is far from over. Please keep checking back for additional information, and remember to subscribe for more updates on the most recent financial news and analysis.